presents some challenges in terms of investigation. So let me start with sort of, with some motivation in terms of background of why this topic became important, in general and in the context of China in particular. So, okay. On the presentation, half of my slide is covered with the screens of participants. Anyway, so basically, the issue of systematic risk in general has always been on the research agenda, right? I mean, so the risks inherited in the banking system, the spillover, contagion effects across countries and within countries. So effectively, the banking regulators were always concerned about the systemic implications of potential distress of financial institution, right? So in other words, in simple words, the failure of one financial institution, as long as it's not, too big to fail, was not an issue. The issue was the crisis, which would potentially spread across the system with major implications, for the real economy, right? Because basically the financial system, banking system in particular, is an important part of the economy in most countries. So basically, any distress, especially the systemic one, has proven to have major implications for the overall level of economic activity. And then, despite the fact that everyone was aware of that, and the events accompanied the global financial crisis of 2008 and 9, they re-emphasized the importance of effective monitoring and control of risks inherited in the financial system, because the crisis itself basically demonstrated that the control mechanisms, which have been developed before the crisis, appear to be inadequate, right? So the global banking financial system was affected to a huge extent, so historically high extent, generated a lot of negative externalities for the real economy. And perhaps the difference between previous crises is that that one was the one in 2008 was on a different scale, and it was properly global, right? So the whole global economy, the whole global financial system was affected to a critical extent. Hence, the regulators across the globe, they renewed their attention, to developing adequate system of monitoring. And whatever was proposed so far, of course, is still subject of a big debate, because whatever has been proposed and implemented has not been properly crisis tested. Hence, the effectiveness of proposals, regulatory proposals, remain highly uncertain. So again, so basically, what I hold on. Now I cannot transit the. I can go back. Yeah. So another important issue is that, despite the fact that systemic risk was recognized as the fundamental concept for the study of severe financial instabilities, and possible policy responses, the attention has shifted dramatically into developing proper measures of systemic risk, right? So not just recognizing it as a, as a source of risk, but finding ways, robust ways of modeling this systemic risk, and hence use it for better monitoring in terms of, use it for forecasting the risk in the system and coming up with adequate policy response. So measurement, so basically the post-global financial crisis, the literature has shifted and paid increasing attention to methodology of accounting for systemic risk. Now, so where does the China come into the picture? The paper we wrote describes extensively the history of Chinese banking system. It has been, reviewed in other sources also extensively. So in order to understand the rise and importance of Chinese banking system for the global systemic risk, one needs to go through the sort of again history of the global financial crisis, and China entered this crisis relatively better prepared comparing to other countries, in a sense that the debt to GDP ratio in China was much smaller than in the developed countries, in the US in particular. So basically, the supply of credit has not been affected dramatically as in many developed countries. Nevertheless, China was highly integrated with the rest of the world. So basically, what happened is that the stimulus, the economic stimulus, were required, and the Chinese government actually extended a record amount of stimulus, amounting to 12.5% of GDP in 2008, probably the largest ever known rescue package, which not only helped China, but also it's been shown it helped eventually the global the recovery of the global economy. And because the fiscal stimulus were channeled through the banking system mainly. In particular, here I mentioned that more than 50% of the funds extended by the Chinese government were channeled through bank lending. Obviously, what it resulted in is the dramatic rise in the size of the Chinese banking system and individual banks. So basically, so before the global financial crisis, again, China was the large economy, but the Chinese banks were not in the top rankings of the global banks. But if we check the rankings in 2018, we would find about 18 Chinese banks among the top 100 banks by total assets. And in terms of risk, since 2015, the number of Chinese banks classified as globally systematically important banks, it's the Bank for International Settlements classifications, widely recognized. It fluctuated between 3 and 4. Which overall led to, again, increased attention to the risks inherited in the Chinese banking system. So again, that was, so the importance, the source of risk from Chinese banks was recognized, internationally, and also in China domestically. So the Chinese Central, the Bank of China, and regulatory authorities, they've been paying increasing attention to the risks of the banking system, the risks of the shadow banking system. There are various crackdown measures, which were also, in with the sort of stock market crisis, periodic stock market crashes in China in the background. So again, the Chinese regulators, the Chinese government is still well aware of the risks inherited in the Chinese banks and potential implications for the Chinese economy. So a lot of measures were and are taking. Nevertheless, again, what we discuss in the paper is that the needs of the actors in the Chinese financial system and the system itself, they are not well adopted to each other. So which results in the continuation of the attempts to circumvent the regulation, and hence there are clear sort of moral hazard tendencies in the Chinese banking system. etc., etc. So, so once again, the issue is, despite the fact that we all agree that the Chinese banking system is a major source of risk, can we quantify it? Can we see, and then if we can quantify it over time, we can see whether the quantitative measures we propose are consistent with with the sort of stylized facts about China and the Chinese banking system. So moving on, I did mention a spectacular credit growth, in globally and in China in particular. And the literature indicates that credit growth itself tends to be a powerful predictor of financial crises, and China is unlikely to be an exception, given the sort of stylized facts about the magnitude and speed of its credit boom. It's widely accepted, both in China and internationally. And if you inspect the Chinese financial system, it's not dramatically different from others. I mean, probably the extent of the issues related to crisis vulnerability lies in the sort of silent characteristics of a system, which is liable to, which makes it liable to a crisis, and that's high leverage in banking, maturity mismatch between assets and liabilities, high, poorly accounted for credit risks, and opacity, basically non-transparent nature of banks. So, overall, here I quote one of the former chief economist of IMF and Professor Rogov, who is a highly reputable scholar, who basically, in sort of one of his less sort of technical notes, emphasized that potential recession in China, amplified by financial crisis, would constitute the third leg of that super cycle that began in the US in 2008, moved on to Europe in the 2010. And despite, basically, he says that, despite that the Chinese authorities doing a remarkable job is postponing something which is clearly inevitable, the slowdown which is inevitable, when this downturn arrives, the world is likely to discover that China's economy matter even more than most people thought. So yeah, so thought-provoking quote, emphasizing that something which has been circulating in one form or another in the sort of in the business periodicals, right? What how likely the crisis to happen? Will the government be able to handle it by bailing out systematically important banks, Chinese government? And if they don't, what will be the implications for the global economy? Vis-a-vis direct exposure of Chinese banks, perhaps, and also indirect, by just the crisis in Chinese banking system affecting the Chinese economy, which is which plays a dramatically important role in the global economy. Okay, so we are not the first one who consider the issue of systemic risk in Chinese banking system. There has been some prior literature, which I can quickly review here. And basically what we discovered is that, some of this literature touches upon the issues which we consider in our paper, but not, again, our argument is that they don't do exactly what we do, and they don't do it as thoroughly as we do. But again, it's important, to relate any results we derive to what has already been seen. So here the literature roughly dates back as early as 2015. I'm sure there's been something written before. So just to give you a quick taste of what has been said in relation to systemic risk in China. The first paper I list here is Gang and Quan, 2015, in Emerging Markets, Finance and Trade. So this offers basically drew parallels between monetary policy shocks, which and systemic risk, and they said that monetary policy shocks significantly increased the systemic risk in the Chinese financial system between October 2008 and November 2013, but had only a limited effect on the real economy. So again, they acknowledge the systemic risk, but they emphasize the implications of it for the real economy. Chen and Du in their paper in Applied Economics, they argue that they basically argue that that for similarity to the Chinese banks to their US and EU counterparts. Yeah, so basically they say that financial innovations in China are related to bank stability, similar to what was found in other countries. Paper by Zhang et al. Talks about non-performing loans and moral hazard and regulation of the Chinese commercial banking system. Yeah, and then they argue basically that moral hazard may temporarily alleviate the problem of non-performing loans, but may cause greater losses to the long run, in the long run due to deterioration of the loan portfolio and institutional stability. Yes, again, this is a very important issue for China, right? Because, you know, any discussion about China basically boils down to the government bailing out banks should they face any major problems, right? Which is, again, obviously that causes moral hazard issues with bank taking excessive risks to cover the losses of the previous lending. So it's basically the problem is getting delayed and eventually is likely to materialize. Paper by Xu Cheng, Zhang, and Yuan. They basically talks about spillover effects that have also become facilitators of systemic risk in the banking sector, right? So basically, and that's, you know, a lot of literature paid attention to that. Whether the problems of one bank, you know, spill over to the problems of other banks. Fang, Xiao, Yu, and Yu argue that institution size is positively related to systemic risk. That's unsurprising, indicating that firms with higher market capitalization are more systematically important. In other words, larger banks are more systematically important. However, they argue that large banks will almost certainly be bailed out by the government during distress, which lowers their risk contribution during the crisis. So again, somewhat controversial point, and we have something to add in our paper on that. Finally, the paper by Sun finds that contagion risk among banks from the default of a single institution is negligible, but the network amplification effect of the losses is significant. So basically, in a network setup, the spillover effects are the main driving factor for bank-specific counterparty risk. So again, yeah, the failure of one, so basically the argument that the failure of one bank might not pose major risks, but it's likely to have a snowball effect, which is likely to be significant. So, okay, so that's it in terms of background. The research strategy in the paper is to use SRISK measure proposed by Brownless and Eagle to estimate the Brownless and Engel to estimate the systemic risk of Chinese banks as an institution's capital shortfall in response to an emerging markets wide shock. So in other words, we are trying to establish links between the decline in the emerging market, in the emerging markets, as proxied by the MSCI Emerging Markets Stock Index, right? And to the decline in equity value and hence capital shortfall, corresponding capital shortfall of Chinese banks. In addition, so that's one approach we adopt here, so SRISK. So basically shortcut for short-term risk. And in addition, we use the Granger-causality network-based approach of Bilio et al. To demonstrate the extensive and complex interlinkages among banks. And then in the process of exploiting these two approaches, we also identify links between systemic risk and the booming Chinese housing market. Yeah. And we argue that the developments in the housing markets are closely linked to off-balance sheet activities of Chinese banks, so-called shadow banking system. And we also identify links between systemic risk and economic policy uncertainty. And I'm going to talk about it in more details later in my presentation. So let's summarize our findings. So first, we show that the propensity of Chinese banks to be undercapitalized when the overall market is undercapitalized. Yeah, so basically there's an overall, there's a global shock, right, to, in our case, to emerging and, probably wider global economy. That's obviously increases the propensity of Chinese banks to be undercapitalized, and the SRISK has increased dramatically in recent years, which justifies the concerns of domestic and international investors and policymakers about market stability. So in other words, our quantitative measure proposed does support the increase in the systemic risk of Chinese banks in the recent period. Complementing the existing literature, we show that smaller Chinese banks their risk contribution has increased also, and it became much higher, and then basically their relative contribution has increased too if we compare these smaller and medium-sized banks to the largest banks. Yeah, so again, it's not only the largest banks which is the source of systemic risk. Our network analysis demonstrates the extensive and complex interlinkages among banks beyond the largest financial institutions. So once again, this Granger-causality shows that the interconnectedness does not only come from the largest banks towards smaller banks, it goes in all directions. And I'll show you these measures in dynamics, right? So again, it's this interconnectedness basically has increased significantly over time, which again, right, reinforces the argument about the increased systematic risk of the Chinese institutions, financial institutions. In terms of relationship between systemic risk and the housing market and economic policy uncertainty, we indeed able to show the significant relationship between two. So there is a integrating relationship between two, and we propose a a meaningful story, what can explain that. But I mean, it's going to be easy to explain when I show you what economic policy uncertainty measures and why we expect the housing market and the level of systemic risk correlate over time. All right, so our data comes from different sources. The sample, it's not easy to get the data on Chinese financial institutions, consistently over time. So our sample focuses on the listed, because again, the type of research we do relies on at least partial use of market data. So we focus on listed Chinese banks. And we basically have the information on virtually all of them. So we've got 17 listed Chinese banks. We have their daily equity returns and market capitalization from data stream. As a proxy for the market, we have MSCI Emerging Market Index and the Chinese banking sector and Chinese stock market indices also from data stream. The quarterly data the information on total assets and shareholder equity, book values, is only available on the quarterly basis, and we are lucky to get it even on the quarterly basis consistently. So that's also from Thomson Reuters. And then we have a couple of externals, a couple of sources for to get the policy uncertainty index and the Chinese real residential property prices index. Right. So this is the basically description on our data and sample. So basically we focus on the largest, most well-known Chinese banks. As you can see, the data coverage differs from bank to bank, and sometimes, most of the time, it's simply related to the listing date of the bank. So even, for example, as I will mention later, the Agricultural Bank of China, which is one of the largest in China, got listed only in 2011, basically became available now data in 2011. So there's little we can do about different starting points, right? So the data is not available before the bank becomes listed, or sometimes it's just, it hasn't been reported. So as I said, data quality and the, availability of data is always a challenge when you do this type of research. And so as I said, our first model is the SRISK model, which is closely related to other approaches. So overall, I mean, it's a market-based measure, and which belongs to the family of the three widely used market-based measures, which is conditional value at risk, marginal expected shortfall, the distressed insurance premium. Yeah. So SRISK, short for systemic risk, is just well, it's similar in spirit to other measures proposed, and it considers firm distress conditional on a market crisis. And again, in the previous literature, which focused mainly on Europe and developed countries, US and European Union in particular, it found that it had some predictive power. Yeah, basically the conditional shortfall in capital when the market is in decline. Yeah, so basically the magnitude of bank undercapitalization. And remember this, the fact that the bank is undercapitalized when the overall market is undercapitalized, right? It basically it indicates the systemic nature of this type of event. So I don't provide the detailed derivation of the model, so which can be found in the papers which we refer to, in the papers we refer to in our paper. So basically, CS stands for conditional shortfall for a bank, or in other words, is the amount of capital needed in a market fall. Right? So remember that the banks are regulated, yes, so the minimum capital requirements are imposed by regulators. So that would be the amount needed to comply with the amount of capital required by the regulator. Right? So again, if we required 8% of assets, right, I mean, the capital has to be 8% of assets, and it falls to 7% of assets, then this 1% in monetary terms will be the amount of shortfall. So LRMES is the long-run marginal expected shortfall with firm I for interval t between small t and t plus capital T. So basically, the percentage reduction in market capitalization. And which is defined here. Yeah, we use daily continuously compounded returns over period T, and the distress threshold C is set to -10% on a monthly basis. Yeah, so basically we model the 10% decline in the MSCI index. Yeah, the effect of the 10% decline in the market index, which can be played around with. I mean, it can be modified. Hold on. So basically, the final form of the test is the following: if there is no capital shortfall, yeah, it's just 0, and then if there is a capital shortfall, it's indicated by CS, yeah, positive shortfall. So basically, as I said before, it would measure the equity buffer that would be sufficient to overcome a possible crisis. And then SRISK is estimated for individual banks, and then we can just sum it up across banks. Yeah, just to explain you our measures of because I didn't explain all the terms here. Yes, L, W. So L is the leverage ratio, yeah, the assets at time T of bank I over its market capitalization, or the market value of equity. We are bounded to use the book value of assets and the book value of equity, but overall we go for the we manage, I mean, as customary in the literature, we use the quasi market value of assets, where basically we only observe the market value of that, but we adjust for the difference between the market value of equity and book value of equity. So that's quite common in the literature. Right? So quasi, utilize, combine book values and the market values. Again, we set the prudential capital ratio at 8%. Again, I mean, as we will see later, I mean, if we use a different parameter, it will just shift our graphs, right? I mean, so it will not matter that much for illustration of what we want to illustrate. And then, so basically, in this setup, what we do, we obtain forecast for long-run marginal expected shortfall via gauge DCC, yeah, following the procedure proposed in the original paper by Brownless and Engel. So again, in the New York University, I mean, they have a page dedicated to SRISK, so where there is a lot of information on the procedure used. So basically, over here you have the aggregate SRISK for all Chinese banks, right? So a couple of things to again explain. It expressed in billions of US dollars, yeah, since January 2006. Yeah, it's on the daily basis, if I remember right. So, of course, there are reasons to be skeptical. So basically, it's the sum of the SRISK for all 17 banks, right, in our sample. Of course, Of course, one has to keep in mind that the number of banks varies across this period. Right, so in the beginning of the sample, the number of banks is much smaller than at the end of the sample, right? So one can argue, of course, it increases because new banks are entering the sample, so maybe that's why, yeah, the SRISK has increased. Well, then, in order to get rid of this type of doubts, we divide our sample according to the date the bank first appears in the sample. So the blue line would be the banks available since 2016, at particular date on January 2016. this would be the sum of the banks which became available in 2008, and this is the sum, yeah, SRISK for banks since 2000, you know, which are in the sample since 2011. Yeah. So again, what we see is that no matter how we, you know, construct the inflow sample, the pattern remains the same, and overall we do observe the significant increase in the systemic risk of Chinese banks. Yeah, the overall. So before the global financial crisis, it was negligible. Then we have the stimulus, right, that kicked in, and then, you know, so again, basically since 2011, the SRISK has been increasing quite steadily, with some, you know, periods of decline related to government intervention in the sort of post-stock market crash period, for example, in 2015. We can also look at the evolution of systemic risk, yes, captured by SRISK for the largest Chinese banks, Big Four, mixed start dates, and all others. And again, from here, we can see that it's not that the systemic risk increased only for largest financial institution, right? The pattern is similar for smaller financial institutions, and as far as I'm concerned, I mean, the gap even sort of decreased, right? So it's not the increase in systemic risk is not driven by a particular group of banks. So it's basically characteristic of all banks. If we look at the Big Four, yeah, China Construction Bank, Bank of China, International, I don't remember, Agricultural Bank of China, Construction, this is Construction, I think, Bank of China. Yeah, so again, there are differences between, so as I said, you know, Agricultural Bank of China appears to have the highest magnitude of conditional loss. So once again, remember, these are just, you know, if the market was declining at this point, I mean, that's how, you know, that would be the capital shortfall of, oh, no, that's not capital shortfall. So this is just, sorry, in this graph, we have relative SRISK. So basically it's the aggregate SRISK of 4 largest banks and the percentage contribution of each bank. Right, so again, so this is weighted contribution, and over here again, this is relative contributions of Big Four and some of all others. So again, we see that historically, right, when the, well, meaningful observations are available since January 2011, the contribution of the largest banks was very high. Yeah, was almost 90%, while over time what we observe is a sort of gradual convergence, right? So over time, oh, I apologize, I think my front door is ringing, so I'll just send someone away. I apologize, it's mail delivery. That's unavoidable when you work from home. All right, so basically, very, very exciting. Yeah, it's that the smaller banks, their contribution to systemic risk relative contribution has increased over time, and at some point was even higher than for the largest 4 banks. Here again, the distribution of systemic risk across time. I mean, here we illustrated since 2012, and so you do see that large banks such as the Agricultural Bank of China, does provide the major contribution to the overall systemic risk, but over time, the contribution of larger banks decreases while the contribution of smaller banks. So over here, the banks which contribute less than 3% to the overall SRISK, they are summed up into separate category. Yeah, some less than 3%. So again, we have the story consistent with that the risk does not appear to come from the largest banks. And remember this, when we say largest banks, they're not only large in China, they are globally systematically important. They are the top 3 largest banks in the world are Chinese nowadays by assets. So how can we explain this, the evolution of systemic risk? A popular measure employed frequently nowadays is economic policy uncertainty, which basically comes from it's an example of a qualitative measure, which comes from the text analysis, for example, of newspapers, how often they, the newspapers, journalists use the term crisis. I mean, basically the keywords indicating increased economic uncertainty, and it has been shown that it is economic policy uncertainty indices sort of complement the traditional measures based on of uncertainty based on volatility of stock indices, etc. Right? So it's been well established. There's a growing literature on that. So over here we plot 1 and 2 year rolling correlations between SRISK and economic policy uncertainty, and we do observe, that they evolved in a similar manner, right? So the overall economic uncertainty seems to be risk to the amount of systemic risk in Chinese banking system. Again, the time series is not very long for any sort of sophisticated analysis. So given the the appropriate procedure is given the number of observations, given the quality of data, is Johansen cointegration tests. So here we report this cointegration test for the relationship between SRISK and economic policy uncertainty for China, and also between SRISK and the real property prices, which and the test indicate that there is indeed a long-term cointegration relationship between 2 series, right? So, which is quite interesting. So again, economic policy uncertainty, right? I mean, is whatever is not captured, it basically captures whatever is not captured in, it's not captured in the financial data, for example, in the stock market data, implied volatility or the historical volatility. Just, basically it captures the public consensus about, about things going on in the economy. So it's interesting to see how it translates into, this higher overall uncertainty translates into SRISK. So there is a positive association. And then the property prices, why did we look at the property prices? Of course, there's a lot of talk about booming Chinese market, real estate market, and the risks of the, of the skyrocketing prices, real estate prices for the Chinese economy, sort of overheating, unsustainable boom. From our perspective, looking at property prices is indirect way of looking into the issue of shadow banking. And a large part of our paper discusses the issue of shadow banking, which is similar to what was observed before the global financial crisis in a lot of developed countries, right? So banks basically try to satisfy the needs of their clients very often by circumventing the existing regulation, right? So basically, the capital requirements are costly for banks. The profitability of banks is negatively affected by the capital requirements. So the banks often find innovative ways of circumventing this regulation and engaging in window dressing and basically channeling funds in a way which would not require setting aside extra capital, right? So in general, the trend of financial services provided by non-traditional financial institutions has become very important in the recent decades. Right? So traditionally only banks could, you can only get a loan from a bank. Nowadays, there are alternative ways. There are alternative institutions, right, which are still closely linked to banks, which can provide services which historically has been provided only by banks. So in China, this shadow banking, there are different estimates. Of course, the lack of reliable data complicates the process. But the shadow banking was the focal source of attention, of the global community for a long period of time. Chinese regulators try to to crack down on the shadow banking activities, because once again, formally, right? So we can, because the idea is that the riskness of banks would be underestimated because the exposure of banks to this shadow banking activities cannot be estimated in a reliable way, right? So basically, the regulators might be, might be under impression that this, the capital shortfall is going to be X, while it can be much bigger, yeah, because of the contingent liabilities which are not obvious, right? Contingent liabilities of the banks. And again, that's something we describe in details. Then our next argument, right, is that despite the fact that shadow banking is not directly cannot be the exposure of an individual bank to shadow banking cannot be estimated credibly, we know that a lot of shadow banking is related to the real estate sector, right? It's basically a lot of it services real estate sector. A lot of deals made through shadow banking, the final destination is real estate. So our argument is that a potentially more or less credible way to see the relationship between shadow banking exposure of banks and the magnitude of systemic risk is to look at the property prices, real estate prices. And again, it seems to be supported. So the growing, the growing real estate market is positively associated with the magnitude of systemic risk in Chinese banks. Now, so again, we have gained a lot of insights, and we at this point, so we can say that the systemic risk is increasing, and systemic risk is increasingly driven by is spread through the financial system, is not concentrated among the top 4 banks. So the next approach, which became very popular in the recent literature, is a network-based approach, as I said. And so what we do in the context of our data, we just explored Granger-causality networks between banks. Yeah, so we move from individual bank or the aggregate to a network of interactions. So in this approach, one can determine the directional return spillovers in the financial system. So in our case, it's 17 Chinese banks, right? So we have time series, for example, J, Granger, we say that, time series, and in our case, it's a time series of returns, of daily returns, time series for bank J. Granger causes another time series I, if information contained in the past values of I and in the past values of J are better at predicting the value of I than the information based only on the past values of I. Yeah, so again, this type of approach has been extensively used in managerial literature, I believe, right? The first time I've used it as a financial researcher. So basically we have pairwise Granger-causalities, and based on this we can construct the Granger-causality network. Yeah, so we're gonna have 17 banks, 17 nodes connected by edges, and the size of each node would be measured relative to average market capitalization of the bank over the sample period. Yeah, so we get something like that, which is not very sort of, yeah, not easily be tractable. Again, more common in the managerial literature. So first I was skeptical myself. Then luckily we can come up with indicators describing this type of relationship. So basically, you know, like a bank can cause, you know, there can be relationship, you know, going from here to here and the other way around, and so various combinations. So what are the measures of connectedness? One measure is the dynamic causality index, the number, which is the number of statistically significant Granger-causality relationship among all nodes. In our case, it's 17 times 16, 272 connections, or pairs of 17 banks over time for the period, you know, from 2012 to 2018. Another measure is in plus out network degrees, yeah, which is depicted like that. So basically the first part of the right-hand side, the relationship is the in network degrees and measures the number of banks I that significantly, yeah, Granger cause institution J. And then the last term on the right-hand side of the relationship is the out network degrees, which measures the number of banks I that are Granger caused by institution J. Yeah, so if you are causing, you are caused, plus you are caused. In and out plus others is the sum of the number of other types of banks that significantly Granger caused institution J and are significantly Granger caused by it. So it's just, you know, just two, you know, different measures to which allow to find out the, you know, the consistency of the relationship you are looking for. So a couple of more measures. Degree centrality represents the number of connections degrees in each node. So the overall degree centrality, and the closest centrality measures determines the mean distance from bank to other banks and captures how close the node is to other nodes in the graph. Yeah, because again, one bank can be connected, you know, can be connected to another bank indirectly. So the question is how indirectly, right? I mean, 2 degrees of separation, 1 degree of separation, etc. So basically CJI is the length of the shortest C connection between J to I. So dynamic causality index, yeah, so how connected the banks are. We plotted over time since 2012. What do we see? That, yeah, indeed, as expected, you know, as basically indicated by the previous results on SRISK, we do see that the connectedness between banks has increased significantly over time. Yeah, so again, varies, but, you know, clearly there is an upward trend. Same insight is supported when we plot the IO and IOO. So once again, you know, no matter the in and out and others, once again, upward trend. So more intense relationships between the banks. When we look at that now, again, as before, we're interested in, you know, is it driven by large banks or something else? So basically, you know, because one can say, of course, you know, like the top, similar to Russia, for example, you know, the top banks are connected to the rest of the economy. So all the smaller banks are just, you know, by default, they have to be, you know, they have to depend on the larger banks. So when we rank banks in our sample by the total connections and by the Granger cost connections, what we observe is that it's far from truth, and top banks are not ranked at the top neither in the terms of total connections or Granger cost connections. Remember, Bank of China, so in particular, if you inspect the previous table carefully, you see that none of the 4 biggest banks rank at the top as either a bank that Granger causes a high number of connections or having a very, very high overall number of connections. So for example, Agricultural Bank of China, remember the one which had the highest contribution to systemic risk, is at the 4th and 7th place respectively, and other large banks are in the middle of the list. So again, and also if you look at the size of the nodes, they will indicate that the banks which Granger caused the most connections are medium-sized banks, yeah, not the largest banks. So basically, as the comments we received before is that perhaps we do too much in one paper, and there is enough information for several papers. Nevertheless, we think that in contrast to the previous literature, we were able to provide a consistent picture related to the evolution of risk in the sort of top tier Chinese banking system. So, and in particular, we illustrate that banks, other than the top largest banks, are becoming increasingly significant as net contributors of systemic risk in the Chinese banking sector. In particular, we provide some interesting numbers, because since these estimates were made for the countries like the US, for example, we can show that the contribution to the systemic risk, the SRISK measure, during the global financial crisis in the US, for the banks which basically were for the largest US banks, was in the range of 7–8% for each individual bank. And in our sample, like the mid-sized Chinese banks have the same percentage contribution to the overall SRISK in China. So basically, what in other words, we are saying that the belief that only the largest financial institutions in China can be a source of global sort of financial instability is far from truth, and the potential banking crisis in China can start in a smaller institution, right, which is not necessarily sort of in the center of attention. And again, it has also been, it's also consistent with what has been observed in China in terms of closures, in terms of failed institutions and government, which institutions were in financial problems and how government dealt with that. So, which again, these examples involve a lot of regional institutions, and as we can see from our analysis, these institutions are likely to be closely connected with the rest of the financial system. So once again, our results with respect to the magnitude of capital shortfall, and in terms of connectedness in the banking in the banking sector, it all indicates that that increasing attention should be paid to smaller financial institutions which possess an enormous amount of risk. Yeah. So again, and in particular, those institutions the risk which those institutions pose, small institutions pose, has become more significant in recent years in terms of both individual capital requirements in the presence of market shock, as well as in terms of network spillover effects among banks. So once again, despite the Chinese regulators' attempt to limit shadow banking, the relationship between fragility of the financial system and increasing real estate prices seems to hold still, and acts as both an intermediary between the real estate and the banking sector, as well as the way for banks to offload risky assets and engage in otherwise regulated activities. So again, more on that. I mean, I can answer, you know, questions if there are any more questions related to that, and I'll or send my paper. And finally, the final remark is that yeah, so is that we do there does appear to be a long-term relationship between housing prices and economic uncertainty, which again disturbingly close resembles what we observed in the countries like US in the prior to the global financial crisis. So basically, a lot of trends we see in China are very similar to what developed countries faced in the build-up to the global financial crisis. Hence, the worries about the systemic risk and the magnitude and of the systemic risk in Chinese banking system are well justified and should, you know, and a lot of attention is warranted from regulators and sort of global financial community. All right, I'll stop here, and you know, questions are welcome. Thank you.
Oh, thanks a lot. This is really interesting, and it's really big paper, as I think.
Yeah, we'll see.
You are right saying that you are combining several in one.
Yeah, but you know, hopefully nowadays you never know. You know, it's either too little or too much.
Yeah.
Now we'll see. We're getting some feedback from Chinese, so hopefully, you know.
Oh.
We are, and it's tricky to write about China, so we have to be sort of, you know, balanced. You know,
yeah.
You cannot be too critical. If you
yeah.
And,
you know what? I already have questions, but I, of course, would like to ask whether anybody around us also wants to put a question.
Yeah.
Are there questions, guys?
I have a little question,
yeah.
But maybe young people better to be first.
Oh, you mean myself? Okay.
No, young people.
Jump in.
Oh, no.
You young woman.
You're playing with fire.
Okay.
Yeah, exactly. Young people. Right?
Okay. So what you see, I would like to ask you, do you think that the really very interesting conclusion that these are not the largest banks which are on the top of all this connectedness and all this you built, but these are medium-sized banks? Is this conclusion persistent with some specific reality for emerging market banking, or is just the global trend for every?
No, I think this is sort of, I wouldn't generalize it. I think it's a result for China. But again, China is so massive that, you know, like that obviously, because the largest Chinese banks are the largest in the world, you know, obviously, and they by far larger than the closest competitor in China. You know, like it tends to attract the most attention, and we're saying that, you know, okay, the government, you know, does the government have enough resources to bail out a particular, you know, these huge monsters, right?
Mm-hmm.
And which was, you know, seems to be the, you know, it's typically the case, because we are saying that, you know, the pyramid will collapse from the top. You know, if the largest banks are in trouble, then that will sort of, you know, channeled that will sort of, you know, go down in the system. Over here, we are saying that, you know, if the middle of the pyramid is shaky, right, and then, you know, it will also collapse. So just saying that, you know, we just have to watch the top of the pyramid is clearly wrong, because you know, you might underestimate how the top of the pyramid, you know, the causal relationship that the top pyramid critically depends on the middle of the pyramid. And in particular, and some of these relationships are not even observable because of the shadow banking. You understand that? So basically, you know, like you do some tricks, you use, you know, like you know, the banks are more connected than we think, and the market data allows us to see it more credibly, right? Because, you know, if you believe in some rationality in the stock market, then basically the stock market would not be based on the officially published reports, yeah, of the banks. They would be they would depend on, on the overall assessment.
Mm-hmm.
Yeah. So in our case, I mean, that's the argument of basically. So if we talk in terms of, the proposed ways of measuring systemic risk.
Mm-hmm.
I'm a regulator, and I know, like, I mean, if the global, if there's a global crisis, in which we basically have now, how will it affect my banking system in China? And then it will affect, by, through the effect on largest institutions, small institutions. So yeah, you're absolutely right. I mean, it's what you pay attention to, I mean, is important. And I think Chinese government, I mean, they were quite well aware of this effect, and they were paying increasing attention to sort of regional banks and specific sort of problems related to, sort of regional arrangements in China. But the interconnectedness, the exact way, it's interconnected, I mean, is tricky to figure out. And there's an increasing literature on shadow banking. But nevertheless, I mean, there are a lot of, question marks. Yeah.
Thank you.
May I ask one question, please?
Yes, of course.
Please.
Evgeny, first, I would like to thank you for interesting presentation. May I ask you, there was slide number 7.
Yeah.
As I understand, it was written that Chinese banks are undercapitalized. Can I just ask whether I correctly understand the statement, and then you can correct me if I'm right or wrong? So number 7, if I think it's the very first bullet point that market is undercapitalized. So do you mean the Chinese banks are undercapitalized because there are these large systemic risks, or there are some other reasons for this?
The keyword here is propensity. Propensity means that, the likelihood that, so basically I'm saying, like, I mean, if we are living in the same family, if I get sick, how likely you get sick, or how, if I get sick badly, how badly you will get sick. So here propensity means likelihood, right? So basically what I'm saying is that if the global financial, if the emerging market index will decline, yeah, the global stock market declines.
Mm-hmm. I see.
I mean, Chinese banks is part of that global, So I'm saying that, if the index declines by 5%, what will be the decline in the equity values of Chinese banks?
Mm-hmm. I see.
If they decline below 8%, which we set as a sort of a regulatory capital requirement, then basically I'm saying that they are undercapitalized. Yeah.
Mm-hmm. Because it's interesting to that's maybe a separate research to understand what you advise to be the optimal capital adequacy ratio for Chinese banks, because there are many papers asking to tighten or to soften. So just that's an idea.
So if you look at the sort of, so obviously this is China, right? I mean, so if you look at the official capital ratio, there are 12%, etc. Like the different tier, right? I mean, there are different obviously requirements, tier 1, tier 2. So obviously, in China, all banks comply with the official capital requirements. So they are all, if you're undercapitalized, you're likely to be restructured. Something has, the regulators will do something about it. So they're not undercapitalized in terms of book ratios at the moment. So I'm not saying here that they are undercapitalized. I'm saying that, I'm talking about data, if they're going to become undercapitalized, if there is a 10% shock, for example, at least 10% shock to the global stock market.
I see.
Yes, so I'm trying to predict how much extra capital would they need if they lose capital.
I see.
So, but okay, and then your second part is that what is the optimal capital ratio? So obviously, like, I mean, taking into account the different contingencies, the more the better, right? I mean, the bigger buffer you have is the same question. So how much do you, if you now, for example, in Russia, there's a pandemic, right? Well, people, not quarantine, but you know what I mean? So basically, some people, some businesses, are staying closed, they have to pay salaries. So it's the same as asking, what is the optimal financial buffer for Russian companies? Like, if you ask that question before COVID-19, the answer would be one thing, right? If you ask now, they would say, yeah, well, you need like, a 2-month buffer, right? So in that sense, obviously, the buffer means that you cannot use this money, to do business. So you just set them aside. So by definition, you don't want to have a buffer because you're not using the money, right? I mean, you don't want to keep the money idle.
Yeah, I see.
So the same with banking, right? I mean, so the economy functions because the credit resources are available. If you impose higher capital requirements, there's going to be less money circulating in the system. And then your second objective is economic growth. So basically the amount of available capital in the banking system is indeed related to the economic growth. So it's a trade-off, right? I mean, so the only way you can, it's basically any value at risk is based on that, right? I mean, so basically you're saying that, like, I mean, what is the acceptable sort of, what is the acceptable amount of losses for you? So of course, I mean, there is a positive probability that, you're going to go out of business. That's true for any business. The question is that, you accept, for example, you impose value at risk, yeah, a condition saying that, I don't want to face more than, 1% risk of losing everything, of going bankrupt.
I see. Thank you.
Or you accept 1%, I accept 2%. So it's a matter of the amount of risk taking and also being aware. So again, you can say that, from the perspective of the Chinese government, one has to be, realistic about how much money you need if bad things happen. You see my point? So one thing is to say that, when investors say, we don't have to worry about Chinese banks because the government will come and bail them out, right? I mean, if they run into problems. So the critical thing here is that you don't mention how much will you need. So if you use money to bail out. Oh, by the way, I didn't mention that, but basically our aggregate SRISK as of 2018 was, I think in the paper I mentioned, about 6% of Chinese GDP. So the capital shortfall of 17 banks in our sample, the overall shortfall would basically mean that if the banks in 2018 would face 17 banks would face capital shortfall, that would amount to about 6% of GDP. So you do the math, right? I mean, so again, 6% of GDP. I mean, it's despite the financial soundness of Chinese government. I mean, it's that's a lot of money. But again, it's consistent with the effect of banking crises on in terms of cost of banking crises historically. I think the papers indicate like about 3% of GDP, the average cost of the banking crisis historically on average globally.
I see. Thank you.
You're welcome.
Alexander Markovich, you also.
Markovich,
Eugene, thank you for a very interesting lecture. And I have 8 questions, but maybe many of them I read to you by letter. But the question...
I will definitely send you the paper because I mean, I want your comments, and then maybe some of your questions are already answered in the paper. But yeah, but go ahead. I mean,
yes, of course. And the main question, is it interesting to you to compare systemic risk in Russian and China's, maybe other countries, maybe emerging markets?
Yeah.
If so, I will contact with you and we think about this.
Yeah.
Okay.
Yeah, absolutely.
You have our book. Where is the part of systemic risk? As Zita said it, yes. And maybe your comments is also maybe very interesting.
Absolutely, yeah.
Okay, thank you very much once more. I think we have time, so I don't speak more.
Yeah. So basically, I can, you know, if other seminar participants, you know, they want a copy of the paper. I don't think it's available online yet, but I can, you know, I can send the working paper version.
Okay, thanks. And if we organize in November our traditional systemic risk seminar, I would like to see you here.
Yeah, absolutely. Yeah, and you're absolutely right. I mean, our original intention was to write this paper for all emerging markets, but then we obviously faced the, you know, issue
maybe we cooperate with you.
Yeah,
if you like.
absolutely. Yeah, yeah.
So I am in contact. Okay.
All right, wonderful. Thank you very much. Anyone else?
Yes.
In Russian, English, doesn't matter.
Can I answer? Can I ask a question?
Yes, please go ahead.
Yeah. Thank you for your presentation. I have a question regarding the government-owned institutions. So I'm not very familiar with the banking system in China. Do you think like the government-owned institutions tend to, like, are they the largest banks probably, and do they like increase or decrease their contribution to systemic risks?
Yeah. Well, the largest institutions are government-owned by definition or controlled, right? I mean, so maybe not 100% owned, but you know,
yeah,
they are controlled. Smaller ones are also closely controlled. You know, the question is the central government or like regional governments, but effectively all 17 institutions. You know, we are talking about the largest Chinese banks, so all of them, you know, are not independent from the, you know, state. That would be naive to say that they are independent from the state. The nature of involvement, okay, the difference is that, for example, the largest institutions, right, tend to be considered like as policy important in a sense that they, you know, I mean, they just can pump through them, you know, more resources, right? I mean, by definition, it's like similar to what in Russia, right? I mean, if the government deals with, you know, banking sector, I mean, they basically focus on a group of the largest, institutions. So I did see something in the literature with respect to sort of difference in behavior of Chinese institutions, that the governments are probably more, basically more moral hazard in the government control institutions, less moral hazard. So I don't think the type of sample we have, the type of institutions we selected is, you know, looking at this distinction between government controlled and non-government controlled makes little sense. But otherwise, you know, like you are right. I mean, one would expect, if you believe that the behavior, you know, the government control affects the moral hazard tendencies in the banks, then that would amplify the systemic risk, yes, in the institutions which are closer to the government, basically. So absolutely, they would be, they would take more risk, and which would increase the contribution to systemic risk of these institutions. But as I said, you know, in our sample, you know, these are the largest institutions, listed institutions to the government. I'm sure they're all of these institutions are closely watched and controlled by the government.
Okay, I see. Thank you.
You're welcome.
One word, as I remember, 4 biggest Chinese bank controlled by government.
Yeah, absolutely. Yeah, I mean, so not only controlled in the sense of, you know, decisions where to give, you know, who to give money, etc. Right? I mean, so
yes, and so they have a little systemic risk.
Yeah.
As in Russia also.
Yeah. but it's all about, again, they're going back to the issue of shadow banking. So there are always, you know, let's say I give a loan to you and I have to put aside 8% of my capital, right, against this loan. But if I give this loan and then I sell it to formally independent, right, financial institution, which will package it. So again, we're going to securitization. So I can give a loan, then shift it off my balance sheet, put it in a securitized product, sell it to investors, and then put it back on my balance sheet with zero capital requirement, because it would be an investment. You see, so I can convert loan into investment and save 8% of my capital. Do you understand what I?
Yeah, of course.
Yeah.
Sorry, could you please repeat it once again? How to convert loan to investment?
Well, I mean, that's what's been done in developed countries, and it's done in a lot of countries. So as a bank, I give a loan, right? I mean, any loan, I mean, a risky loan is subject to 8% capital requirement. Yeah, so if I give you 100, I have to put aside 8. I give you $100,
Yeah,
I have
that's
to
clear.
put aside 8. Now I give you a loan and I sell it to my, you know, to my friend who takes, you know, a bunch of my loans or, you know, other loans, puts them together, creates a fund of these loans and sells them to investors. So basically creates an investment product. And then as a bank, I can first sell the loan and then invest in the packages of this loan, in securities which are secured by the packages of this loan. And formally, it will be lower risk.
But
right?
but currently there are requirements for investment in funds that also bear credit risk, and they are assigned somewhat 1,250% risk weight.
Not for the loan, yes, but when I buy something diversified, right, it might be ranked AAA. You see my. So basically,
well, I see, but then so if it's AAA, then the risk is like with credit rating agency that it's misassigned the rating. But
yeah,
if it's AAA, then it's true. Yes, the risk weight is low.
But that's the thing. And then the question is who bears the losses, right? I mean, so again, I gave you a loan. If you default on this loan, who will be the end bearer of this cost? That's the question. You know? So sometimes it looks like the bank is no longer exposed to the risk of this loan, right? I mean, which I talked about. While in fact, yeah, if the default occurs, the bank will be the final bearer of the risk. Do you understand? You see the point?
Yep.
Formally, like, you don't owe me money, but if you don't pay, then suddenly, you know, the system will start unravel, and then it's gonna end up on my balance sheet. Mm-hmm. So basically, there's a lot of these contingent losses are hidden, and they're hidden either through wealth management products. So basically, because remember, the Chinese interest rates are also regulated, so I cannot just, you know, attract deposits by offering high interest rates. Mm-hmm. So the only way to do it in China was exactly shadow banking allowed that exactly. So the banks cannot offer you higher interest rates, but if we do something on the side, mixing up, you know, creating new financial products, these financial products can pay higher rate of return.
I see.
So basically, you know, there are ways of sort of circumventing this, you know, the interest rate ceilings, et cetera, and all this at the end of the day results in a risk which is not properly accounted. You see, but it's the same in Russia, right? I mean, so, you know, basically, you know, like on paper, you know, you send the periodical reports, right? On paper, all banks comply with the, you know, with the regulation of the central bank. Once the problems start, then, you know, you discover that, well, I mean, they're only compliant with these regulations on paper, right? So a lot, you know, so there are basically legal or semi-legal ways of hiding risks and, you know, and saving, you know, like basically off balance. So what I'm saying is that off balance sheet liabilities are not subject to the same capital requirement. Do you agree with that? If you can make if you can shift your liabilities from balance sheet to off balance sheet, that
I think it's a separate discussion to leave outside the current conference because there are credit conversion factors, etc. But it's an interesting topic.
Yeah, but I'm just saying that they're trying to increase their rate of return. This rate, they attempt to increase rate of return, through shifting it to off balance sheet. It's all related to hidden risks, which clearly show up. So on paper, all banks are financially sound in China. Obviously, the stock market, according to my calculations, the stock market does not think so.
You mean multipliers are small?
Yeah, well, formally they're all, in line with 12%. They all hold the capital which the Bank of China requires them to hold.
Yeah.
But it doesn't mean that they're all equally risky, or it's enough for all of them.
Okay.
Agreed.
I need to just to finalize this type of a discussion, because we are out of time, out of schedule. And this is really very interesting and really very deep topic that you touched before. And it's again an invitation. We do hope in autumn there wouldn't be still this very sharp wave of virus. Despite we are waiting again, there would be some waves in the nearest future, but maybe in November it will be possible to travel, and you're really welcome to come. And of course, we can discuss it via mails, and there would be a seminar. We can just also collect some other people from Russian banks and just to
you can also try to update the paper with the effect of the coronavirus pandemic.
Yeah. Oh, good.
Because it is a global shock, right? I mean, so it's interesting to see.
Yes, and you have here Alexander Karminsky and also Genrich Penikas, who asked you about this conversion of loan to investment.
Yeah, absolutely. No. It would I would want to look at the papers which are part of the volume you're submitting to.
Okay, I already sent. I sent Ruben Makarian to Elettra Aliardi. Just look, please.